Is the Roth 401k really the best option? Now, I'm going to go through a question today to talk about the Roth 401k versus the traditional 401k to help you decide when to use which. Now, this is going to start with a question from someone that left a comment on my Roth 401k video. And I love the debate, the open discussion, but I wanted to tackle this because I know there's a lot of people out there who think Roth all day, every day, no matter what. And that's not always true. So hopefully I can open your eyes to using both as we go through this. But again, if you have questions, let me know in the comments down below. I love the debate, love the discussion, so continue it. So thank you for that. So let's go ahead and pull it up on the screen and go through the question and break it down. So the question starts with, I respectfully disagree with your example. I think the correct way to display it would be the following. And let's go through the following. You invest $1 into the 401k Roth and are taxed 20%. So you pay 20 cents in taxes, which is taken right out of your paycheck, but you still have the full $1 invested in the 401k Roth. $1.20 total taken from your gross. So let's just start with that. Before we go through the whole thing, let's just write this out, okay? So we have to understand how we're actually taxed when the money's going into the Roth versus the traditional side. So if we have our paycheck, this is where it's coming from, our paycheck. So our paycheck's going to do one of two things. Either it's going to go directly in as a pre-tax contribution to the traditional 401k, or it's going to be taxes withheld, taxes, I'll just put a W for withholdings, taxes withheld, and then that money would then go into the Roth side of the 401k. That is the only way that this is going to occur. Now, in your mind, you might think, okay, this money is going to go into my 401k, and I'm not going to really pay the taxes from here. We're just going to put it directly into the 401k. And maybe psychologically you think that money comes from somewhere else. And that's fine, because sometimes we pull money from different accounts, usually with the Roth IRAs or the traditional IRA. But in this case, it is going to come directly from your paycheck. So those are the only two ways that this money can get into the 401k. Directly from your paycheck to the traditional side, or directly from your paycheck minus tax withholdings into the Roth side of the 401k. Now, what gets confusing here is that we're just saying, oh, I want $1 to go into the 401k. Should I put it in the traditional side or the Roth 401k? And we're really neglecting to think, what happens to your end paycheck? Well, that end paycheck is extremely important because that's what's going to affect your taxes and how these contributions actually get made. And for most people who are doing this, they're trying to figure out like, hey, can I get the money? Do I have enough money to do this? Is my paycheck going to be big enough to pay my bills or do everything else that I need while I'm also saving? So the example before we get into the comparison here was, and I haven't watched that video in a while, but it's one of the ones that you compared to. So I'm going to use 20%. So if we put it in the traditional IRA, it's going to be pre-tax. So our $1 is going to go directly in there. If we assume the same investment, let's say it doubled to $2, and then later on we took it out, assuming we're in the 20% tax bracket. So 20% of $2 is going to be 40 cents. So we got $1.60. So $1.60 is what we're going to be able to pull out if we follow this through the traditional side. On the other side, the Roth side, this is after tax. So if we were to say that we're going to put $1 in here, well, there's got to be another 20 cents to pay those taxes. So because we're trying to compare apples to apples, and the way that you should look at it every time, this isn't up for debate, this is fact, is that you're going to withhold the money and that's what's going to be left over. So in order to really compare this, it has to be the 80 cents. And at 80 cents, that then doubles because it's the same investment. And it doesn't always feel like that. It's, well, if I start with a smaller amount, I should have less. Well, if the taxes are the same on both sides, then it doesn't matter. So that would double to $1.60, come out tax-free, and that would still be our $1.60, okay? That is the only way to look at this. So let's go back to the question. So you invested $1 into the 401k Roth and taxed 20%. So that's what it's doing. We're saying we're investing the money in the Roth, but we're going to come up with the additional 20 cents in taxes. And to keep apples to apples, let's say you invested $1.20 in a traditional Roth and it is not taxed from your income at all. Well, that wouldn't be possible. So I don't know if that's referring to the Roth IRA as a traditional Roth side, Roth IRA, or if it's looking at saying we're putting in the traditional side of the 401k. I'm not really sure exactly what that sentence is referring to. But that's not true. If it is going to the Roth side, it is after tax. Even if it was a Roth IRA, it would still have to come from your checking and savings account is basically the way you should think about that. But those dollars, again, are right here. So if it goes into the Roth side versus your checking or savings account, let's put a check and an S for checking and savings, that's the same thing. It doesn't matter. We're still getting our tax withholdings. Even if we're not withholding taxes at the end of the year, we're still paying taxes on those dollars. And so then we're going to jump down to the last part is now say you're ready to retire and they both grew 10x. Your 401k Roth is worth $10, tax-free and clear. Your traditional 401k is worth $12. Well, I don't know where you got the $12 from. I don't know where that's necessarily coming from, but you still have to pay your 20% taxes. So now you're showing a lesser amount, but it's still not apples to apples because it's just not. There's just no other way to look at that because you have to do the withholdings for the Roth side before the money goes in. You're going to pay the taxes on those dollars. That is the only way to look at it. And the only other way to spin it would be to say, I'm going to hit the limit. I have an unlimited amount of money. So how can I get the most money in those accounts? And in that instance, if you're saying I can only get whatever year you're talking about, the easy math, we can use 2023 numbers for 6,500 into your IRAs. 6,500, where am I going to put this 6,500 if I have, let's say I have $10,000, $12,000 more and I just want to max fund it, right? That's what you need to be looking at. So if that's the case, you might still think, hey, the Roth's the best way. And it's still not. It's still not. So let me pull this up and show you why. Because there's another component that I always talk about when we're comparing apples to apples that does sometimes lean it to the traditional side. And again, I'm not opposed to having massive accounts in both. I personally do. But if the thought process is Roth all day, every day, no matter what, you might be missing out on free dollars. That's the way you can look at it. If you're making this smart move, put more money back in your pocket, how can you do it? With credits and deductions. Let's take a look. So let me pull this up right here. So this is the Google sheet that I always talk about that I have on our Discord server. So if you want this sheet, it's on our Discord server, which is a link in the description at the bottom. But let's look right here. Let's look at 2023. What you could possibly be missing for deductions is, well, one of the credits right here is the Savers credit. Now, not a lot of people might qualify for this, but if you put the money into the traditional side of your 401k into the traditional side, then you might qualify for more credits. And if you can get it below these numbers, depending on your filing status, then you would qualify. How should you look at that? If you're thinking about getting additional credits or deductions, think of it like saving on taxes. So now I just showed you the example where we had the same amount of taxes on both sides. But then that would mean this is like a use it or lose it for the Savers credit. If you qualify for the Savers credit in the year of the contribution, then you get a tax credit on it, depending on how much and your income that you put into your IRAs or your workplace plans. But that means this part right here would be more beneficial because you're going to pay less in taxes. So then that scenario would actually outweigh the Roth side. And it doesn't always feel like that because all we think of is, if I have an investment and it does really, really well, then all that money is going to be tax free. It just, if you're in the same tax bracket, it's irrelevant. And even if you have massive gains, it's only on the distributions. So it's also likely that you might not still be ahead, even if you did really well. And remember, flipping over to the traditional side, it's the same thing. There's no difference. It's apples to apples. It's the same investment. That's the only way to do the apples to apples. Keep it on both sides. Now, a lot of people have it in their minds that they're going to be in a higher tax bracket. So that's a really big argument too. But again, you have to look at what's in front of you today, the credits and deductions. And let's continue on that. So let's take a look here and scroll up. Look at if you're a much higher income, because maybe that's what you were thinking when I was showing the savers credit. If a much higher income, we can look at the Roth income limits. So maybe you already have a traditional IRA with a bunch of money in it, so you really don't want to do the backdoor Roth, potentially, and don't want to roll the money up to your workplace plan. Well, this could be another reason to put more money into your traditional side. And then when it comes time to do the Roth IRA, you're below these limits. So that's another thing to consider. There are just so many of these things that you can go through. Another one that I've talked about in the past is the if you're a small business owner and you have a health insurance through the marketplace, again, another one of those credits depending on your family size, and that goes up significantly. It's 400% of the poverty line. But again, imagine you got your income way down by saving a ton of money on the traditional side, and then you just saved a bunch of money in health insurance costs. There's just so many different ways. And a lot of the Infrastructure Act that just came out, I know there's a ton of stuff in there that you could potentially qualify depending on your income. So you don't want to blindly go onto the Roth side. That is the point. Again, I'm not against it. Tax-free money, yeah, it sounds great. But the reality is that this stuff gets missed a lot. And a lot of times when people are bringing this stuff to me, they're saying, hey, this is my situation and I'm all about the Roth side. Hey, that's great. I appreciate the fact that you want to save a ton of money and like tax-free dollars, but don't miss those credits and those deductions. That is a big factor in making sure that you're balancing it out. It's not terribly hard. If you want to know about some of the credits and deductions that you might qualify for, you can also look at the IRS's W-4 estimator on the second to last page. It has a whole list of them. It just makes it easy to look at. You can go through them and say, hey, do I qualify? Do I qualify for the savers credit? Do I qualify for the child tax credit? Depends on where your income is. If you're looking at 200, if you're single, 400, if you're married filing jointly, it begins to phase out on the child tax credit. Again, just a little bit more that you can put in your pocket if you just take a minute in advance to see what you potentially could qualify for before you just make the decision one versus the other. But in reality, the example that I run, comparing the two at the same tax bracket, that's just fact. There's no other way to dispute that. However, you could dispute the fact that you might be in a different tax bracket later on in life and you're in a lower tax bracket today. That's usually the argument. And to some degree, maybe that makes sense in some situations, but you just got to look at the sum of all of the parts and not just each little component while you're going through it. So hopefully this has helped. I appreciate the debate. Let me know in the comments down below. Go over to our Discord channel and check it out. We just started it a couple of weeks ago. And if you've enjoyed this video, be sure to subscribe and we'll see you on the next one.